Taking stock on Bloomberg, I'm Pim Fox. According to my next guest, we are just starting to see a recovery in emerging markets. Well, should they be the first to recover? Let's find out the details. Ori Landsman is the head of global growth at ING Investment Management. Ori, good to have you with us. What numbers, what data are you looking at that tells you that we're starting to see growth, particularly overseas?
Well, the first good economic data we were seeing was coming out of China. Now, I'll admit that sort of some of the most recent data has been less encouraging, but clearly GDP growth in China appears to be headed back to that 8% plus rate. There's definitely been a lot of production there, and therefore a lot of demand for raw materials, and I think that's one of the reasons why the Chinese stock market has been so strong this year.
But let me put it to you. When you talk about China, number one, isn't that kind of the redirection of government investment? I mean, it was an export-directed economy, and I understand the thesis behind domestic consumption, but can you turn an economy that's the size of China on a dime and focus it inward?
That's a really excellent question, Pim, because let's say in 2008, about 45% of the Chinese economy was exports, and we all know that that demand is falling off dramatically. So they probably had to replace something like 1,000 basis points of demand in order to keep GDP up. That's a tall order, even for a centralized economy like China. There's no question that they have tried to stimulate that. They've kept employment very high. They're producing a lot of stuff. The question is there demand anywhere, either in China or overseas, to sop up all of that production?
You think that exists?
Well, I think that some of it can be replaced. There's no question, though, that probably about half of it will have to be consumed by their leading export partners like the U.S., like Europe, like other areas around China, and that is just starting to come into play.
Is there a disconnect between what is going on, let's say, in the United States and what is going on overseas? Because I was talking to Mark Faber earlier today, and he was describing how, you get all this government spending in the United States, but what happens? That ends up stimulating economies overseas because we don't manufacture all these consumer goods anymore. Does that make sense?
Well, it certainly does. And obviously, for virtually every emerging market economy in the world, especially in Latin America and Asia, the United States is a very, very key trading partner along with China. And so he's very much right. A lot of this stimulus is getting exported, so to speak, and helping those countries come out of their doldrums. Some of that is being felt in Europe and Japan, but not as much and not at a proportionate rate.
All right, so let's talk about some specific markets. I'm assuming we're going to do Asia right now. What, in addition to China, would you be investing in?
Well, I think the other way always to play Asia is the areas surrounding China. So obviously, first of all, we're talking about Chinese companies that are listed in Hong Kong. We're talking about Hong Kong-listed companies in Hong Kong, and then also technology markets like Korea and Taiwan that sell into it, and even selected Japanese names who export primarily to China.
I noticed you didn't say anything about commodity names. Is that just because we didn't get there, or are you a little bit leery about chasing the commodity bull run?
No, it's because we didn't get there. I'm actually still remain very, very bullish on energy materials. It's been a very, very successful trade so far this year, but I still think there's room to go, particularly in the metals.
And what about Australia? Would you be pouring money into, let's say, Australian iron ore mining companies?
Okay, iron ore, I think, is an interesting question. That is sort of a commodity in and of itself. The Chinese still haven't agreed to pricing for 2009 in iron ore. So as it happens, I have been avoiding Australia directly, although it's a little bit of a misnomer because there's a lot of major mining companies that are listed both in London and in Australia. I happen to be playing the London listings and the ADRs as opposed to the Australia listings, but certainly the commodity story that I'm talking about, Australia would be one of the large beneficiaries of that.
What about the real estate as an asset class in Asia? Would we be putting new money to work there?
Yeah, absolutely. That's probably one of my top calls, and that's both within the Hong Kong listed names, both the Hong Kong real estate names and the Chinese real estate names that are listed in Hong Kong. If I'm right that commodities are going to continue to run, inflation is going to be an enormous issue. Real estate should be an enormous beneficiary of that.
What chokes off this thesis? What kills it?
The single most important thing that chokes off the thesis is a lack of global growth, which means that all the production that China's been doing in the first half of the year literally sits there on the sidewalk or whatever it is they have there and doesn't get sold anyplace. What would happen in that event is China would suddenly turn off ordering all new commodities and things from the outside world, and then we would really have a second dip in this market.
Now, if your thesis about China is correct, what about investing in U.S. or European companies that do a lot of business in China, specifically in the infrastructure space?
Yeah, absolutely a very good idea and an area where we're investing. So actually, other than selected markets like China, Brazil, and Russia, the United States is our favorite market in the world. So we believe that the stimulus is likely to take hold here, that even though the United States has had a nice run, even though there may be a short-term pullback, we think the United States finishes the year a lot higher than it is right now. We like that play. We like energy, material, infrastructure names in the U.S., both for domestic consumption and for export to places like China.
Now, last time you were here, you talked about having made a trip to Europe and talking to European investors. They were totally underweight. In fact, they didn't have any weighting in U.S. stocks. Has that changed?
I think it's changing, and I think some of the major market appreciation since the last time I've been here is cash coming in from the sidelines, some of it from Europe. I'm getting about 10 times as many calls as I used to from Europe, people asking, is it too late? Can we still get in? How should we get in? So I think that's a story that's going to have legs to it, which is Europeans seeking better returns than they can get at home, getting exposure to the U.S. market, and probably more in the growth names.
All right.